Oil surging again, bond market falling apart, gas prices in the US through the roof, and consumer sentiment has arguably never been worse, at least in recent recorded history. The reason I picked this title is I believe that volatility is mispriced. The market is not valuing volatility. It's not implying volatility anytime soon. I think that can't be the case. Bitcoin is starting to kick and scream a little bit, and we know that Bitcoin usually leads. It usually tells us inklings of what's going to happen in the future because it is such a free market.
Bitcoin is screaming a little, but according to Jack Mallers, that scream is about to get much louder and much harder to ignore. Right now, the market is sending signals that most people are still missing. Bitcoin has just reclaimed the $80,000 level, a key psychological zone that analysts now see flipping from resistance into support. After bouncing 15 to 20% from recent lows, we're entering what traders call a magnet zone, where price action historically accelerates fast and violently. Institutional money is flowing back in. Nearly $2 billion in ETF inflows in April alone, plus continued accumulation from large holders, is quietly building pressure under the surface. At the same time, the technical setup is aligning. A potential golden cross is forming, one of the most reliable signals of sustained bullish momentum in Bitcoin's history. But here's the key point. This rally isn't happening in isolation. It's happening against a backdrop of rising geopolitical tension, surging oil prices, and increasing instability in traditional financial markets. Mallers believes Bitcoin isn't just reacting randomly, it's responding to stress signals in the global system. Oil is surging, bond markets are starting to crack, consumer sentiment is collapsing, and yet volatility is still being mispriced by the market. In other words, the system is far more fragile than it looks. And Bitcoin, as the most free and reactive market on Earth, is beginning to front-run that reality. So in this video, we're going to break down exactly what Mallers is seeing in the oil markets, why bond volatility could trigger the next wave of money printing, and how all of this ties back to Bitcoin's next major move. If you want to understand why Bitcoin might not just hold 80K, but explode beyond it, make sure you stick around. And before we dive in, make sure you hit like, subscribe, and turn on post notifications so you don't miss any part of Mallers' insightful analysis and the latest update on the Clarity Act. Every cycle, people make money in crypto. Every cycle, people lose it to hacks, exchange collapses, and compromised accounts. iTrustCapital's premium custody fixes that. It's a closed-loop system. Crypto goes in, but withdrawals only come out as USD to your verified bank. Nobody can drain your wallet because there's no external wallet to drain. Assets are held one-to-one, off-balance sheet, with full tax reporting. And inside an iTrust IRA, gains can grow tax-deferred, or tax-free in a Roth. Real U.S. customer support. $100 bonus when you fund through the link below. Same market, smarter structure. Thanks and enjoy the video.
So you can see from this tweet from Jim Bianco, what does the oil market think? Both the July orange and the December blue Brent crude oil futures contracts are at new highs, And this is dating back to the beginning of this year. The December contract is now signaling that the market expects crude oil to be above $90 for the next 7 months. So the reason looking at futures contracts are important is because they're trying to price, hence the name, the future of the physical commodity. They are derivative for forward pricing is what it's called. Risk transfer of forward pricing. And so the reason that this is valuable is we're like, whoa, markets expect that crude oil is going to be worth over $90 all the way in December. The blue line is when the contract settles in December. And so you can hear all of the talking heads on TV, all of the politicians, all of the paid podcasters. Hey, no sponsors. I'm not paid. Man of the people. But all the rhetoric trying to convince you to believe their bias or believe what they're being paid to say. What I care more about is I love markets because markets force people to put real time and energy on the line, real capital on the line. Words are cheap. Words are easy. Words are free. Money's not. And the fact that futures are saying that oil is still going to be at or near $100 per barrel, even by December, what does that tell you guys about the level of disruption in these markets? What does that tell you guys about the conflict? So earlier today, Iran had an attack on the UAE. The UAE announced it, and Brent crude went from 110 to 120, and it's back on the run. It's back on the rise, just screeching higher. And again, considering everything is a derivative of energy, this is going to have grave impacts on the world we're living in. And obviously, as Bitcoiners, I had someone ask me on a podcast recently. I recorded a podcast on Friday. I think it'll be out on Wednesday, maybe. And he said, well, what's your answer when people say, why do you care about the Strait of Hormuz? Why are you always talking about this macro stuff? And it's because Bitcoin is a solution to a problem. And the problem is fiat. The problem is the legacy finance system. And I benefit from and enjoy trying to understand the state of the problem and how bad it really is and how I can best position the solution, which is Bitcoin, for the world that we're in right now. People are caring about different things. There's different stuff ongoing in the world. And so the fact that, Brent crude oil is above $120 a barrel, that's really meaningful. Gas prices are starting to really, really, really move. So you can see in the green line here, gas prices are up 33% this year, and it looks like they're just getting started. We're already almost at the 2022 gas price high, and we're already higher than the gas price highs of the 2008-2009 great financial crisis. So gas prices are really starting to move. And I wanted to highlight some stuff because you're going to start seeing economic data. I've seen whether it's central banks or whether it's commercial banks or whether it's governments around the world, they're starting to cite strong economic growth. They're saying, oh man, the US economy or the European economy or whoever is booming. There's so much spending. There's so much economic activity. You're going to start to see that and hear that. And there's a Fed chair change. Obviously, Warsh is expected to be coming in and Jerome Powell is now done. And I wanted to highlight a really important point in that, yes, nominally, so in US dollar terms, things are quote unquote booming, right? Like the amount of dollars moving around and being spent by consumers looks high. But the question is, what are those dollars being spent on, number one? And number two, what about the real economic terms? So instead of measuring things in dollars, which we know get debased and are worth less over time, what about measuring things in real terms? So first on the left, you can see this is increased spending on gasoline is likely to weigh most on the real consumer spending. And so you can see this average effect baseline of an oil shock, energy goods on the far left, and then all the way on the far right is housing and utilities, healthcare. And when you have an oil shock, the amount of capital being spent just on energy goods, just on oil, is unbelievably high. So I wouldn't say the economy is booming if people are just forced to spend and dip into their savings just to fill their gas tank, just to pay the electricity bill, just to get by. On the right, you can see U.S. retail sales by kind of business, and look at gasoline stations. Gasoline stations sitting at 15.5%, and then furniture and home furnishing is second in 2.2%. And so again, I encourage you guys always pull on the thread, think critically, think for yourselves. Yes, nominally, there are more dollars sloshing around the U.S. economy, but it's all on energy goods, derivatives of energy, gas stations. That's not necessarily a good thing. And I pull on the thread a little bit more in this slide, and you can see that adjusted for inflation, consumer spending is pulling back tremendously.
What Mallers is really pointing out here is something most people overlook. Energy is the foundation of everything. When oil markets start pricing in sustained disruption, like Brent crude pushing toward 100 plus for months ahead, that's not just an isolated commodity story. That's a signal that the cost of running the entire global economy is rising, and we're already seeing the effects. Gas prices are surging. Consumer spending is being squeezed. What looks like economic growth on paper is increasingly just people spending more money on essentials like energy, not actually improving their quality of life. When you adjust for inflation, real consumer strength is weakening, and that's a critical distinction. If the problem is a system built on constantly debasing currency to sustain rising costs and debt, then Bitcoin is the perfect response to that instability. And as these pressures build, capital naturally begins to look for alternatives that aren't tied to that same system.
So let's take a look at how bond markets are doing. Oil is driving bond volatility. Oil's impact on the bond market. I would argue that oil in the blue is driving bond volatility in the orange, not the other way around. That means wider daily ranges and, given the current environment, higher yields. So bond volatility has been one of the most important metrics to understand when the money printer is coming out. The U.S. government's got $40 trillion worth of debt. A really simple way to think about the U.S. government and the current filthy fiat financial system is a highly indebted system, a highly levered system, tons of leverage. We're all familiar with leverage on this podcast because we're in crypto. We know that if you're super levered and the price moves a little bit, you get liquidated. And you can think of the US government in the same way, extremely, extremely levered. So what does a highly levered, highly indebted system not like? Volatility. Volatility is scary. And the very specific reason why the US highly levered system doesn't like volatility is a lot of the people that are lending to the US government are doing it via what's called a carry trade. These are hedge funds that are levering up their balance sheet to lend to the US government. And when the collateral that you're posting is experiencing volatility, then you have to de-risk and then you have to pull that trade back. And when there's a lot of bond volatility, the market gets weaker. The buyers kind of step back because all of these fast money traders, they can't lever up their balance sheets when there's volatility. And so the fact that one of the most important, if not the most important commodity is experiencing a shock, is experiencing supply chain shortages around the world. And again, Japan imports, I think it's 90% of their oil and over 50% of their food. And these are all of these global supply chains are in serious trouble because everything's a derivative of energy, of things like oil. And so the fact that oil markets are all messed up is going to mess up everything else. And you're starting to see volatility in the bond market start to peel back up. And this is, by the way, the MOVE index, which is the bond volatility index. This is the same index that shot up during Liberation Week that forced Trump to taco and forced the money printers to come out in storm. And that sent Bitcoin from whatever it was at the time of April of last year of 25 to 125,000 by October. That run was money printing, it was stimulus, and it was in a reaction to things like bond volatility. And you're starting to see bond volatility creep back up because I'm telling you guys, you cannot take 20% of the world's oil offline, one of the most important supply chain vectors in the Strait of Hormuz, offline and expect the world to function as normal. These things like gas prices are going to go up. Inflation is going to come back. U.S. consumer sentiment is going to be as bad as it's ever been. Combine that with AI. Combine that with the fact that people are comparing this to, what about when we were in 2001? What about in the 90s? Yeah, but in 2001 and the 90s, we weren't $40 trillion of debt. You cannot keep borrowing from your future, not paying it back, and comparing us to times when, it's like the equivalent of comparing a runner who's running a mile who's in pristine Olympic shape versus comparing a runner who's running a mile in the Olympics that's obese. It's these are not comparable things. The U.S. has a ton of excess weight. It is obese and drowning in debt. I mean, it's just not going to work. So the bond markets are falling apart. So again, bond math confuses people.
In other news, the long-stalled Clarity Act, arguably the most important crypto market structure bill in U.S. history, is suddenly gaining momentum. After months of deadlock, lawmakers have reached a compromise on stablecoin yield. Crypto firms won't be allowed to offer passive interest just for holding stablecoins, but they can offer rewards tied to actual activity and usage. Despite this partial victory, banks are pushing back hard. Major financial institutions are warning that even this compromise falls short, arguing it could still pull deposits out of the traditional banking system. Their concern is simple. If users can earn rewards through crypto networks instead of parking money in a bank, that threatens their entire funding model. This shows just how disruptive crypto has become. And if this bill passes, It opens the door for institutional capital that has been sitting on the sidelines waiting for regulatory clarity. We're talking about a structural shift that could bring trillions of dollars into the space over time. At the same time, geopolitical tensions are escalating again, and this ties directly back to Maller's oil thesis. Donald Trump has confirmed that Iran fired on ships during Project Freedom, prompting U.S. forces to respond by destroying multiple Iranian vessels. Now, South Korea is reviewing whether to join U.S. operations in securing the Strait of Hormuz, one of the most critical oil supply routes in the world. But Iran has issued a dire warning: we have not even begun yet. Which means we could see further escalation of the conflict in the days and weeks to come. This brings us back to Bitcoin. Because in a world where energy shocks are driving inflation, where debt-heavy systems can't handle volatility, and where governments may be forced back into money printing to stabilize markets, Bitcoin becomes more than just an asset. It becomes a release valve. Bitcoin isn't just moving, it's reacting. It's anticipating. It's, as Mallers put it, kicking and screaming ahead of what could be a much larger shift in the global financial system. The real question is, are you paying attention to the signal? If you found value in this breakdown, make sure you like the video, subscribe to the channel, and turn on post notifications. And most importantly, drop a comment below. Do you think Bitcoin is about to enter its next major expansion phase, or is this just another temporary breakout? Thanks for watching and see you in the next one.